Recording in progress.
Good morning, good evening, good afternoon, and welcome to the 2022 Master Trader Program with Mark Minervini. My name is Bob Weissman. I'm your moderator for the weekend and do want to welcome you to day 3 of the event. Today's curriculum will be approximately 3 hours, 15, 20 minutes or so, and then we will have a live question and answer session with Mark and Mark as well. Any questions you do have regarding the curriculum from the first weekend, day 1 and 2, as well as today, can be emailed to me at bob@minervini.com. Please do not type questions into the chat box because they get lost very quickly and will not be able to be recovered to be asked. Today's attendance, of course, is strictly prohibiting any audio or video recordings and sharing of the information you are learning from Mark Minervini here today. Our event is sponsored by MarketSmith, by Investors Business Daily exclusively. They are our official sponsor, and brought to you by Minervini Private Access. So today we are going to start with failure reset. This is page 261 of technically volume 1. It's the last part of volume 1 that Mark still has to get through before we get into volume 2. And with that said, I will share with you, we'll have a few breaks after each of the sections today. So again, I believe we'll have 3 breaks during the curriculum portion. We'll take a break after the curriculum is over, and then we'll get started with the questions and answers after that. Also, as a reminder, a replay of today's session will be at 6 p.m. Eastern Time, New York time. It is with the exact same material from this morning that will be shown again this evening. And also the same links and log-on information is what you'll be using for all the sessions. Again, some people have asked me for new links. It'll be the same ones. If you're here already, of course, you're already in the room, but for tomorrow, day 4, as well as the live training day on Monday, November 21st, there will be additional questions and answers available on Monday during the live training day. But tomorrow, day 4 of the curriculum is purely curriculum, as it's an entire day event for that. Again, entire day meaning about 5 hours or so. We'll get more details of that tomorrow. But today's curriculum for day 3 starts on page 261. And with that said, let's get started with Mark and Mark.
Okay, everyone, welcome back. Day 3, 2022 Master Trader Program. Not seeing myself up in the video here, so I hope that I am actually recording. Can you see me, Mark?
I sure do.
Okay, great. Hope everyone else sees me. Real quick, our sponsor is MarketSmith, and just want to remind everyone once again, on live trading day, we'll be doing a tutorial on MarketSmith. We'll have somebody here from MarketSmith. I think it's Scott St. Clair, and we'll be going over the MarketSmith product and how we use it. So just wanted to quickly point that out. Let's see here. So right now, we're going to talk about something that we call a failure reset. And that is where when you get into these chart patterns, these VCP patterns, sometimes you'll be early. And particularly, this is a really good time to talk about this, because when you're in a bear market, you're in a correction, especially when you're in a large correction or a large bear market, you can get bear market rallies, you can get false signals, if you will, and sometimes you'll have these VCP patterns set up, and they get tight on the right side, only to find out that they needed more work, and that it was just the beginning of what needed to be a longer or have more contractions, or even sometimes some widening of the volatility, and then a retightening. I'm going to show you that right here. So again, you start seeing these patterns. You're doing your screening, or maybe using MarketSmith, and you start seeing these patterns show up. We tend to get really excited when we start to see a bunch of VCP setting up, because that's a potential. Those are opportunities. And then when you set up that pivot right there, that tightest point in the right side that we refer to as the pivot, if you take out the low in that pivot, and sometimes you can break out and then you reverse and take it out, and sometimes you don't break out at all in a really weak market, we call that a pivot failure. And then what that does is that sort of reestablishes the count. So if you were to, let's just say this was 20%, this was 10%, and this was 5%, now it comes and takes that out. Well, maybe this is now 8 or 9%. However, as long as this is this pullback here is still in that single digit, you're still tightening up enough to just to be considered for purchase if it should turn around and then break out from there. So you have to do the math. You have to, it's real important that you're cognizant of the percentage declines and know exactly what's going on in that tightest portion. There's another thing that I forgot to point out before, and I want to I want to tell you about this right now, and that is that generally what we find is that when you get these pullbacks and these contractions, they usually they have themselves, and not always, but sometimes it's 1/3, 1/2. But generally speaking, you'll see like the first pullback might be 27%, the next one 16, 17, 18, the next one is maybe 8 or 10. They're usually about half of the previous decline, give or take. So that's just something to be aware of as you're watching this. They don't have to be, though. Okay, you can have, if this was a 10% decline and this was an 8 or 9, that would be, of course, a lot more than half of the previous decline, and that would still be fine. So what'll happen is a lot of times, and again, like I said, in a bear market, we'll have where you have some rallies off the lows, and sometimes you'll get a setup, and the market will either start rallying, and they'll get some stocks setting up, and they'll rally, they'll break out, or a few stocks will set up. You'll see a handful of stocks setting up, and then as the market goes to lower lows, the stock will experience a pivot failure, and it'll take out that low. But then when the market turns back up, you'll have these stocks will start to break out. And the main thing is you want to stay with the count, okay, and just keep making sure that that right side is tighter than the previous pullbacks, and that it's in that single digit range. Because once you get outside, you start getting to 12, 15%, 20%. That's just too much. That's too much volatility. It's too much risk. Now, and Mark, of course, this is something that you know a lot about, and you tend to, I've seen over the years, we call this a failure reset. You tend to play a lot of these failure resets. What's the trick to, spotting these things and then sticking with them and keeping that discipline of not getting, discouraged if those initial setups don't pan out?
Yeah, I think part of it is back to the point we talked about being weak holders. You want to think like a weak holder. And so, when you look at this is obviously the hypothetical, but when you look at that sort of little pivot leakage, that often knocks out a lot of weak holders, myself included, or Mark and myself will sometimes get knocked out of a stock, but you don't just give up on the name. Now you don't run right back in and buy it. And we'll get into the examples of how this works, but often that subsequent setup is even better because you've knocked out previous weak hands. Now you may have been a part of that shakeout, that we talk about, but that's okay because if the name comes back, it potentially shows that it is under institutional accumulation. Our timing might just been a little bit early.
Yeah, and what happens is as the stock goes through these iterations, you can actually get a much improved setup that takes a little bit more time. And those shakeouts that, just like Mark said, that shakes you out, you're a weak holder. It's also shaking out other weak holders. And that is, once again, letting the stock go through that natural progression of wringing out that water, once again, wringing out that supply. So sometimes, excuse me, sometimes you come down and you really get volatile, and it takes another tightening, and you might have to go through another tightening. And then from there, if you were, saying this is a 1, 2, 3 T, and now it takes out those lows, well, now it would be 1, 2, 3. And some people have said that this is sort of like Elliott wave. Not really, it's really nothing like Elliott wave. It's simply just, measuring the percentages and then looking for the tightenings to culminate to where on the right side, on the very right side, there's symmetry and there's enough tightness in price that you're not taking too much risk. And when we say taking too much risk, below that pivot point, below the base, those are the areas that should hold. Once the stock breaks out, those areas in a good market, and if the timing is right, you get everything right, those areas usually hold. So it's abnormal for the stock to get below those levels. So we want those levels to be mathematically acceptable. So these are the technical levels that we would maybe put our stops, but they're still within the confines of the prevailing math that we need. And so let me show you another. You can also get where maybe you have a larger correction, a much larger correction in the market, and you get a bunch of setups. We've seen this before where everything looks really good, and then it comes crashing down, and the market needs another big leg down, and it washes all the boats. Takes all boats with them, and now you come off and you undercut the lows in the base. That sometimes takes a lot longer to set a larger base, and then you have your other techniques. Now you might start looking for low cheats or cheats, and then it'll build a handle later on. So that's why we have these various points and levels to get on, like they showed you, the low cheat, the handle. That the reason why we have all these different levels is because it's very unlikely the stock could set up in a way where it comes out of a base and it's not going to at least give you either a pivot point breaking out to new highs, a low cheat, a cheat. Somewhere in that base you're going to get one of these or all of these setups, and that's the goal, is to have enough tools or tactics in your tool bag that you'll be able to get on board before the stock takes off. Now, I mentioned that almost all the stocks that I'm showing you here, a pretty good portion of them, up 95% of them, are all stocks that I traded. Doesn't mean that I traded them all successfully. This happens to be one that I traded unsuccessfully and turned out to be where I made the error of not re-entering on what we call a failure reset. So there's two kinds of resets. There's a failure reset, a failure pivot reset, and there's a failure base reset. The failure pivot reset is when you undercut the pivot, but not that much damage has been done. So you could reset pretty quickly, and sometimes you'll just get another little tightening. And this was, of course, Craft Brewers. I bought it right here, and it had this little, it squatted on the breakout and then came back in, and I actually got knocked out of it. But then shortly after, it was just a couple days later, it tightened up. And like I said before, it can improve. This was actually an improved setup because now you've shaken out more supply and you've tightened up really, really nice here. Look at the volume. It comes way down, and then you can see you got the 1-2 punch. You got the low volume and then a huge volume coming out, relatively huge volume at least, coming out in a really big breakout. And if you take a look here, one of the reasons why I studied this one is because I got knocked out of it. I missed the reset, and this is what happened in 26 days. I was standing on the launch pad watching the rocket from the ground and not enjoying the ride. So I you should always study the stocks that you make mistakes on, turn out to be big winners. Study them, find out, could you have gotten on board at some other point? So the failure reset is something that that we use, and it can happen sometimes in tumultuous environments where, and again, like, see, this could be a company that, the earnings, just because the stock goes down 5%, 6%, 8%, that doesn't mean that the company all of a sudden is doing poorly and they're not earning money and the business isn't doing well. But see, we have to manage, and why don't you talk about this, Mark? Why is it that if the company's doing so well and we see the earnings and everything's great, then why would we sell if the stock just went down a little bit? Why not buy more or just hold the stock and go through that? Why sell it 7 or 8%? Why would we cut our loss?
Well, I mean, in terms of, are we talking on risk protection mode?
Yeah. Why would,
yeah. Well, the short answer is risk of ruin, of course. We're never let a losing trade turn into an investment. That's one of the worst things. But look, the reality is, like we showed in a lot of these previous examples, how many of these topped while the story still looked great, and the earnings were, they might have still been triple digit even, but it's already been priced in because the market is, again, it's discounting the future. So we don't, I've heard Mark say this many times, but every 50% decline starts as a 5% pullback. And we have the humility, in my view, to say we don't know what the future is going to bring. But we know, your first loss or your best loss is your first loss. And the only way to avoid big losses is to take them when they're small.
Right. We don't have a crystal ball. We don't know. Now it's 5. If you don't sell it at 5 or 6 or 7 or 8%, well, where are you going to sell it?
By the way, I want to add though, just to this slide, because it's ironic. This was right before the very first Master Trader program. This was 2010, because I traded this as well. And I remember there weren't too many of us, and Mark showed the slide and he said, this name, stopped me out. And then I made an error, meaning it set back up and I didn't jump back in. And I remember, I don't even know if you'd termed it the failure reset yet. I wasn't even sure, but I remember writing down saying, this is how you get back in an aim. Making the notes to say, because what often folks do, they get stopped out and then they throw the name off the list. And that's to my point before. Don't, some pivot leakage and that type of thing. It doesn't mean you take it off your list. And this set back up. And I was standing on the launching pad with him because I didn't know that this was a technique, Then years later, it was something, again, you just add another tool to your toolbox to say, okay, if the pivot shakes out, but then it retightens, and see how nice the volume comes right back. It shook us out and then took off without us.
Was this all the way back in 2010?
This was 2010. I remember it well.
We don't have the year here, but I didn't remember it was that far back. And let's look at another one here. And again, we don't have a crystal ball. Risk has to be managed in real time. With the benefit of hindsight, yes, hey, we should have held that, but we don't know that in real time. So in real time, we've got to protect ourselves. And the whole key is to keep the losses smaller than the gains. The only way to avoid a big loss is to take a small loss. There is no other way. I've been doing this for 40 years. I have not figured out another way. If you know another way, feel free to tell me. I'd love to hear it, but I can tell you.
To add one more thing too, Mark, I don't know if you remember, because you and I did an interview earlier this year with Jared Dillian, and he asked us, what do you do when you get stopped out of a stock and then it sets up and breaks back out? And either you or me, I can't remember, one of us asked him, well, do you think the stock knows you that it stopped you out already? Because some people act that way, meaning, well, this stock stopped me out. It doesn't like me. That's precisely how amateurs think. The stock doesn't know who any of us are. And the idea is, if it sets back up again, and we're talking about supply and demand, this YY is a perfect example. It retightens, actually at a little bit of a higher price, which I think is even better, and then blasts off.
Yeah, well, I remember that conversation, and I think my answer was, let me ask you a question. If you lost with a pair of aces, would you not play aces the next time you got them dealt to you? And he said, right. Of course I would play them. That's exactly right. So it's the same thing. It doesn't change the probabilities. As a matter of fact, it can improve them. The fact that you got shaken out, a lot of other people got shaken out. And once again, right back to that towel, you've just wrung out more supply. Okay, so keep that in mind. So here, just a couple examples. I just want you to see the concept here, because this is going to happen less than breakouts that just go or just fail. But you will get periods where you get resets, and you'll get situations where you get resets, and you want to have a reentry mechanism. Part of your plan should have a reentry mechanism as long as the stock meets the criteria. So again, this is one that, big base tries to come out here. It's a little short here, doesn't really drift back much, so it gets a little shakeout. You get that pivot failure, but it just was a little early and needed more time. There's another one here. Oh, actually, this is actually where it's set up again. It's the same stock. So it came here and then it did a similar type thing right here as it set up another base, and see, it came out, and then this time it didn't actually outright fail. It just squatted and pulled back a little bit. That's another thing that we should talk about a little bit. When you get a stock that squats, it comes out. We call it a squat. It's just when it reverses and it sits in sometimes the mid or a lower third of the range. Sometimes it sits all the way at the low of the day, which is more ominous, of course. But a lot of times the stock will break out. It'll come out of these bases and it'll break out, and then it'll pull back. You might even put you at a small loss, and it'll squat. Generally, I'm not selling on that. That's not a violation. I'm going to stick with my original stop. If, let's say, I went in there and my stop was 8%, I'm going to stick with that because I've already decided that that's the amount of risk that I want to take. And that one day, unless it was a huge range and it maybe engulfed the whole pivot and you had a pivot failure and it was more than just a squat, it was actually a big reversal that, would take a lot of price action to get above it. Maybe it goes up, 15% that day, it comes all the way back down, closes on the low. that would be one I'd take some off, or I'd sell it. But just normal stock popping its head out and then coming back a bit, what will generally happen is you'll get what we call a reversal recovery. Very often, half the time, the stock will just pause another few days, and then you'll get that follow through buying. And that's what we were talking about earlier with the confirmations. Look for subsequent days. It might not happen on that initial day. It might take a couple days before the volume comes in and the stock starts following through.
Just to point out too in that last chart, Mark, you see how you mentioned it briefly, but you see how similar those two bases look to each other? I mean, those are just like, they rhyme, they're almost perfect examples of how the stock runs up on volume. And then as it's putting in that base, the volume just starts drying up, and it does it one right after the other. That is exactly a picture of the stock going through that process we're talking about, of the strong hands slowly accumulating as that stock is pulling back. The institutions are stepping up and taking out all the weak hands until it dries up and then moves higher.
Yes, absolutely. So in this instance here, you can see pretty strong, quick shakeout here, and a gap, has a decent close, but then comes right back and tightens up. See, it tightens up right here. And this is actually, and this right here, this breakout attempt, sometimes what will happen is the breakout will happen. And in hindsight, you'll look and you go, that really wasn't that great of a setup. And when you see it in contrast to the newly tightened right side, you'll see that it was just part of the process, and that you got it maybe a little bit wrong. It was wedging up a bit here where you didn't really pull back and create a shakeout. Shakeouts are important. When you shake out lows and you shake out pivots, you undercut previous lows. That's where a lot of traders will have stops. So as you undercut those lows, that's the part of the process of taking out that supply and taking out those weak hands. Remember, we want all the weak hands to be eliminated in the stock, and we want to be the last weak hand. That's the real key to this thing, is that you time it so it's really, really tight, the volume's really low, and that will give you some insurance that you are, if not the last weak hand, you're very close to being the last weak hand, and that's when the stock can really take off.
Mark, is this a good time too to talk about how that shakeout came right back into the range? Within 2 days, you were right back in there.
Yeah, sure. Let's talk
well,
about
I just think that's a good, sometimes people ask, it'll shake out a low, but then the stock will stay down there near the lows, and people will say, is this a shakeout? What you want to see is the stock come down and then it gets bid right back up, meaning, that somebody is down there with an appetite for those shares, and then it comes right back in the range.
Right. That gives you an indication that it truly was a shakeout where weak hands just got, maybe there was some panic selling, some retail selling, and that institutional buying just gobbled it up, and the stock came right back once it got those weak hands out. The quicker it comes back once it shakes out the low, the better. If you get a nice close, and that's where we were looking before. We're looking at, we want to see demand. Remember, I showed you how I want to see demand coming off the lows and up that right side. Very often that'll come after you shake out a low. And that can also happen within that right side where you're developing the pivot. But when you compare this breakout attempt right here to where it reset, this to the astute or keen eye that knows how to decipher these things, this is a much better. And I think just as what you've learned so far, you can see that this is a much better formed and really nice tight pivot right here versus this right here, which didn't really spend much time tightening up. Let's take a look now on the failure reset. Like I said, you have the pivot reset and you also have the base reset. The base reset is when you set up and then it fails, but it not only takes out the pivot low, it takes out the base low. So now you've had a full-blown base failure. And what will happen in this scenario, if you do reset, it's going to take longer. You have to think of when a stock has a break, if it comes down, the more it fails, the more it breaks, the more it takes out key levels or takes out lows in the base and so forth. The worse that break is, the more it goes down. It's like an athlete that has a broken leg versus if you have a sprain. So if you were to undercut the pivot, that's like a sprain. Okay, maybe a sprained ankle. You can recover from that a lot quicker. The stock can then tighten up a little bit, and within days, it could be back in viable position. However, you take out the lows of a big base. Base is formed over 26 weeks. Now you take out the lows, and there's this big volatility. That's not going to be viable as far as the criteria that we're looking for that tight price, because now all this supply came in and it would just be too much volatility. It's going to take longer. So in this case here, I bought if you remember, I showed you where I bought Dick's Sporting Goods. Well, I was actually watching this right here, where it was setting up perfectly. This was setting up really nicely and getting nice and tight here on the right side, but it never broke out. It never broke out of the pivot. What happened was it set up right into, this is the market right here. This is the S&P 500. The market started rolling over. Right as it set up, the market rolled over and the market took it down. But right away, if this stock came ripping back, it took out the low of the base, and just like Mark said, you get that good close, and with just a few days later, it comes ripping back up on a huge gap and right off the lows. And now the stock market index, the S&P, went to a lower low here. And now it's actually divergent. Look at the relative strength line. See, the relative strength line is going up now because now it's dramatically outperforming the market. And right here within this base building process here, where you're starting to build that right side of the VCP, the relative strength line, look, has already gone into new high ground. And then it went into new high ground again, but the stock hasn't yet broken out. And then it tightens up even more and it gets really tight. And now you're setting up for the 1-2 punch right here. Look at the volume, comes way down and then bang out, and here comes the big volume again. This is not a coincidence. This happens over and over and over. You just have to learn to be able to spot this under the right conditions, and you'll be able to take advantage of it. Let's show you here. So I guess I was supposed to go through this, and I just explained it all on one chart, but you can see here the market comes off, stock comes off. Next chart. And now that initial little setup is just part of a larger VCP. Okay, so again, you might be early. Check the earnings, see if the stock is still, if it's got all the characteristics, and stay with it. If it comes ripping back, the relative strength line is moving up. You have all the good numbers, then fine. If it sets up, then you go back in the stock. Let's take a look at another one here. Elan, I showed you this before. This is a stock that I bought in 1991, coming off the 1990 bear market. Again, it was setting up right here. It actually got my eye over here, but during this period right here, from here to here, you were in a bear market, right? And the market actually bottomed right here, and the stock went a bit lower even after the market bottomed. So now the market is, by the Dow or the S&P, was down 23% during this period, and the stock held up pretty good. But finally, the weight of the market, whatever, got a hold of it. It undercut the lows, but see, it came ripping right back. And again, I had already been watching it over here, and I did not buy it. And then when it came ripping back here and it really got tight, I started watching it here. And then when it tightened up like right here, really, really tight, that's where it really got my attention. Look at the volume. Volume comes way, way down, and you get this nice tight price. And I bought it right here, coming right out on that day. Let's see another one, Baidu. So sometimes you'll get V-shaped. V-shaped isn't as good as U-shaped because, again, it doesn't give the stock enough time to go through that process of wringing the towel, getting the water out of the towel, getting the supply out. So what will happen is you'll come off, especially if the V-shape is very deep. You come off 50% and then you come straight back up. You're coming right into those trapped buyers, and you're coming right off the lows and giving the bottom fishers very quick profits. So you're gonna intersect with both of that selling, and that's what happened here. So it had to bring the stock down again. Now you have a more U-shaped, or you have more time, right? And now it's able to go through that process. You shake out the low, right? That knocks out a lot of weak hands, and now you come up the right side and you start forming those tighter buy points. You get a cheat and you get a handle here, and so you reset the base. This is a base failure, then a reset. One more here. So this is Chef, and you can see here, this is actually absolutely perfect. This is set up perfect. Comes out and it's acting perfect. Just like we talked about confirmations, violations, we got, let's see, 1, 2, 3 days up out of 4, 5, 6, like 7 out of maybe 7 out of 8 days or so, or 6 out of 8 days. Everything's acting perfectly fine. Now it comes in, and this isn't looking so natural anymore, right? You probably would have got stopped out at break even, or maybe even it hit your stop. You're knocked out of the stock. Now it comes ripping right back, gets really tight, has another little shakeout here, and then really tightens up right really nicely. And see, now once you're able to go through that process of tightening and having those shakeouts, the supply's gone. And that's why this can happen. 12 out of 13 days up, it just comes ripping back, because at this point, that is when you got the supply out of the stock. You got to get the supply out of the stock. That's the key to watch for, is to get good at watching the stock and deciphering when supply has stopped coming to market, because at that point, the stock could be very explosive. Let's see here, let's look at another one. This was Spirit Airlines. This was David and Ryan and I were watching this stock for a while. This is when I used to actually talk to David quite often. We were on Skype like every day, talking about stocks sometimes, throughout the day. And I remember we were watching this name, and it had tried to come out of this base, but then it came off and it started looking like it was failing, but it tightened up here. And this was back actually when I was using load sheets, and Dave was still a little skeptical about load sheets because of the supply. And since then he's come around with the cheat areas quite a bit, and he uses it. And so I was explaining to him on this particular stock that I thought that we could maybe come right from this little tight pivot right here, and that was a place to start buying. And I bought some right here, and it moved right up nicely. 5 days up. You had 10 out of 11 days, and you see it never set another pivot. So you had to use that load sheet to get on board. But this was a form of a setup. This is a pivot. This is a pivot failure. You come out here and the pivot fails, and then you set up a cheat. So you're always going to be looking for the load sheet, the handle, some type of volatility contraction. Even if it's a reset, you're still going to be looking for the volatility contraction. At least I am. I'm always looking for the volatility contraction. Mark is always looking for the volatility contraction. David Ryan is always looking for volatility contraction. That's where William O'Neill was always looking for volatility contraction, because, and again, to give credit where credit's due, the concept of supply not coming to market, of analyzing a chart to learn or to uncover where supply diminishes, is Bill O'Neill's. I mean, I had a conversation with Bill O'Neill in person, and he explained this to me, and I did not get it for a while. And when I explained it, Bob Weissman, when he first started working with me, he was trading, I was explaining it to him, and he didn't get it for quite a while. And I said, well, I didn't get it either, so I don't expect you to get it completely. It took me a while. And then when I finally realized what was actually going on here, I realized, wow, this is so fundamental. This is just simply supply and demand. That's it. We're just trying to find out where there's high demand and not much for sale. No different than any other auction market. Spartan Motors. This is one that Spartan Motors, I traded back in the 80s, and then it set up here in 2016. So again, this is a very creative, I would say. I stuck a creative one in here. You came off of this load sheet here, a smaller base, but you had a quick shakeout, and then came right back and it tightened up. Look at it. Look at the little pivot it forms right here, and then bang, comes out really fast. We also call these, sometimes they don't even pause very much. They just shake out, and then within 3 or 4 days, they go right back into new highs, and that's a much harder one to get on board. We call it a Hardaway crossover. For those of you who don't remember, Tim Hardaway was a basketball player, and he had a really mean crossover. He would go left, right, and he was gone, and he would shake and bake players. That's what a stock can do sometimes. Once it gets that last shakeout, when those weak hands are gone, boom, it's just free to go. So, but without waiting for a pivot, your chances of success, your probabilities go down, and the chances for volatility that will shake you out of the stock go up. So we want our probabilities to be the absolute best. So we always wait for that pivot point to develop. At this point, we're going to move to the second volume. So you're going to be going to the other workbook, whether you printed it out or you have it electronically. We are going to go to that workbook. I hope you've been taking notes. The best way is to print it out. I know some people do it digitally and can take notes digitally, but it's really important that you do take notes. We're just going to go right into the next section. And before we do, I want to just recap real quick of the things that we talked about. So we started off with categories and catalysts, right? We're talking about the various types of of stocks and industry groups and the way that we analyze these various different areas, the market leader, the top competitor, the institutional favorite, the turnaround situation could be a little bit different, right? If it's a biotech, earnings aren't going to be nearly as important as some kind of growth company. If it's a turnaround situation, we're going against easy comps. So we're going to have big earnings in the most recent quarter. So the tactics are applied a little bit differently depending on when we identify what category we're in. Valuation takes care of itself if the earnings are there. If the earnings, and the bigger the earnings, the more that the valuation doesn't matter as much, because it's because you can't really value it. You can't value a company that's growing at 100 times earnings. It'll have a PE of 500, because the earnings are growing so fast. That PE can go from 500 to 50 in a matter of a few quarters if the earnings are strong enough. So the PE is not a very good measure of value when you get into very high growth. If you're getting into really, really low growth names that are big cap companies, it has a little bit better. It's maybe useful to a certain degree, but even then, not really. Fundamentals, remember, we only talked about three things: earnings, sales, and margins. That's all I look at. That's essentially what Bill O'Neill looked at, David Ryan, Mark Ritchie. We're growth investors. We're looking for growth. We're looking for a company that is very simple. The stock market is not like some special set of business principles that's different than any other business. We're looking for businesses that are making money, making revenue, and making profits. It's just like if you were to go buy a business, you'd look at it and you say, "Wow, this guy got a great product. They're selling a lot of the product, and they've got nice profit margins. They're making a lot of money." If that's the case, company's going to be worth more money. It's going to grow. But the thing is that we know that the stock market is a discounting mechanism, and there's a lot of intelligence in the stock price, because you got a lot of smart people analyzing these companies. So that's baked into the cake. They're looking out. They can only see so far, though. That's why the real strong earnings, they can only see so far, but a lot will be baked into the cake. So that's why we have to use price and volume and make sure that the stock is performing, differential disclosure, that everything makes sense, right? And then finally, entry points. We talked about entry points. Now we're getting into really honing down, and we're starting to go to from that satellite aerial overhead to actually getting under the microscope here and really looking at. We looked at the confirmations and violations, not only the entry point, but then what to look for after the entry point, whether the stock's acting right or not acting right. And then, okay, so it's not acting right. Well, we keep our eye on it. We keep our eye on it because it might reset. The fundamentals might still be there, but it just wasn't. I call it fundamentally sound, but not price ready. Okay, it could be a fundamentally sound company, but is it price ready? Because why? We want the right price. We don't want the lowest price. We don't want the earliest price. We want the right price. The right price is the price that just before it takes off gets us at a profit. So we're making money, and we're doing it with the least amount of time. All right. Okay. So that's a summary. Let's I think I did a pretty good job off the top of my head there. Let's move on to the primary base. So the primary base now, well, let me just say this. There's two very important opportunities, or big opportunities, that you get in the stock market. One is what we call a potential magnitude opportunity, or magnitude play. The other one is what we call a velocity opportunity. So the magnitude is the primary base. And the reason why is because you have the opportunity to get the biggest move out of a stock, because it's the earliest that you can get on board, because the stock just recently came public. So it's the earliest in the life of the stock. So I turned it a magnitude opportunity because you could make the biggest move. And when you go back and you look at many of these companies that are household names now, like a Yahoo or a Google, Microsoft, any of these names that all of us would know, Amazon, Netflix, they all had an IPO at some point, right? And almost every one of them gave you an opportunity to buy them from a VCP, from a sound base, and from a systematic approach, pretty early in their cycle, in their life cycle. Usually within the first time they formed a base, or within the first uptrend very early on. So we call this a primary base. The primary base is the first buyable base after the IPO. Buyable, that's what's important. So it has to set up a VCP. So let me show you some of the names that I was buying, and where I was buying them, and the setup. Yahoo, we've talked about this before. This was the first time that I had bought Yahoo. I took this. I was in New York City at the time, and I was advising some of the biggest institutions in the world. And I took this stock to a lot of my clients, and no one wanted to touch it because it was trading at 938 times earnings right here when I was buying it. So you can see it broke out. It had 2 days of pullback, and then what do we get here? What's that? Tennis ball action, right? Rips right back, acting perfect. This stock went up almost 8,000% in just a little over than 2 years, in a little more than 2 years. I did not hold it for that big move, but I traded a whole bunch of times. And from this point right here, I made over 100% the first time, and the second time I made over 100%, and then a few other times I made 60 and 30, and really strung together a really nice gain from this. Let's take a look at Amazon. This is the first time I was buying Amazon. Again, it went IPO, fell apart, and then took some time. And then finally, it formed this nice little tight pivot on this right side, and I bought it right here, coming out right here. This stock went up almost 80,000%. If you just put this one away in the lockbox, it would have, given you a nice retirement. In just 16 months, 2,500% from here. So really a great buy point here. Just recently, not too long ago, this company, and the symbol was BLTE, set up almost in identical fashion here on this right side. So take a look at Amazon. Take a look at where that's set up right here, and now look at this one. Almost identical. When I saw it, I immediately thought of Amazon. This stock rocketed. I don't know if it's going to turn out to be an Amazon. I think since then it's come in quite a bit, but this stock rocketed off of that pivot point and went up almost 200% in just 21 days. So again, real powerful. See, all the supply is gone, and when you get that supply demand imbalance, it's a rocket ship, right? Let's show you another one here. Starbucks. Now keep in mind, at the time, you may say, oh yeah, Amazon. No one knew Amazon, and everybody hated Amazon on Wall Street. Absolutely, they hated this stock. The word on Wall Street was that Amazon would never make money, and you would never make money on the internet, which turned out to be completely as wrong as you possibly can get. Starbucks, all these companies that now everybody knows. When I was buying many of these, nobody knew these names. Microsoft, even Costco Wholesale. Nobody knew Costco Wholesale when I was buying it in 1991. So again, but you can see every time you get a VCP opportunity, you get a VCP opportunity even right off the IPO. DIX, we already talked about that. I had some analysis here on DIX, but here's a good another point here, because David Ryan, when he used to do the Master Trader program with me, he used to always bring up this point, that some of the best IPO opportunities happen in bear markets, and they happen. You should look for the IPOs that came public off the lows, or when the market's down big, because the stock market is a business just like any other business. When the market's doing great, they can sell anything. So they start selling all the crap. All right. And on top of the valuation, they can get a much bigger valuation because everybody's hungry for stocks. They'll buy anything at that point. But then when the market's down and conditions aren't right, now the belt gets tightened, and you can only really sell some really good merchandise. It's just hard because people won't buy anything. And the valuation, you're not going to be able to ask the big valuation because, again, everything's tightened up at that point. Everybody's tightened their belt and conditions aren't good. So always look for the 96% of stocks that make big moves come out of correction. So you want that also goes with IPOs. You want to look for stocks that have recently IPO'd, and you're not looking to buy the IPO. You want to wait until it forms a VCP. You still need to time those stocks from a low risk entry point, but that's the best time to be looking for IPOs. And many of these came out of market corrections. I'll show you a couple of others. These are all stocks that I was buying. So Abacus Direct, again, 450% in 28 months, right out of here. Perfect, absolutely perfect VCP. You see it just tightens. So it gets really tight right here. And here's the weekly. You're going to see the same thing on a weekly. All right. So whether it's a daily chart or a weekly chart, you're going to look for the weekly to look good too. Now, look at the weekly here. See the big bar? Look at the big demand off the lows. That's exactly what you want to see. That's institutional demand. And now what you're waiting for is once you see that institutional demand, you're just waiting for the supply to quiet down, to get rid of those weak hands so you can get back in sync with that big demand. A few more. Borland traded this one right here. I'm not going to go through every one here. Let's move down a little bit because there's a lot. I'm giving you a lot of these examples, more than we're going to go over, jumping forward here, because I want you to have a bunch of precedents. I want you to use this workbook as a model book where you've got the precedents, and now you can look for stocks that look similar, and you can learn what these are supposed to look like and the concepts. Ollie's, we talked about this before. I was buying it right here. And then I added to my position right here because it got even tighter. It got really nice and tight. David and I were, Ryan and I were buying it on this day right here. We were both buying it on this day. And I had previously bought it right here. We were both watching the stock, and I bought it a little bit earlier as it just started turning up. And then he came in there and bought it, and we were both buying it on that day. I'm pretty sure we were on Skype together on that day. I remember. But again, you see, you had a market here where you actually came off here. Remember I talked about you have some of these rallies and bear markets or corrections, and then they fail. It's exactly what happened here. Market rallied, and then it rolled over, but that's where we got the sore thumb. The sore thumb stuck out. Look at the relative strength line. It just blasts off, and it goes screaming into new high ground during a corrective phase. The market takes out the lows, but you're making higher lows. While the markets has all this volatility and everybody's all bearish here, you've got a perfect, picture perfect, absolute aces VCP setting up. Mark, does it get any better than this?
No, I was buying it right alongside you there as well. I was just going to say too, in my experience, sometimes these take, and you're probably going to show the LinkedIn and, some of the other examples. Some of these can take a year or two even, where the stock it builds this bigger base. I think this one was maybe, 6 or so months. There again, the institutions, sometimes when these stocks come public, you got, people who were in the thing prior that are selling, and other folks are buying, and the stock's noisy. And then while these institutions start accumulating, you can see in a couple of these examples up the right side, look at all those blue bars. And then to David's point, sometimes the market is helping you. That weakness in the market is a great sign if this stock is, or these newer stocks are holding up. I remember this one particularly because David was I can't remember, he was on a call with MPA or something, and he said, you realize these guys, I think it was Ollie's that had I think they had 100 stores, and they had plans to do, 500. Every single store was profitable. David had done more work on the fundamentals. I think you and I were just looking at the technicals going, yes, this is the perfect base. We don't care. We're buying it. But it all came together at that perfect time. And this was one of those names too. You bought it and you were just under no pressure. It was everything. This is a perfect example of how everything works together from what we've been talking about from the first almost minute to right here where this stock sets up.
Yeah. So two things. One, David came to he flew to speak at the Master Trader program when we were doing it in person. And David and I went to Ollie's to go see the stores in person. So that was doing some,
maybe that's what it was. Yes, I remember
kicking the tires at the highest level there. So take a look here though. Look at the contrast. Look at the volume contrast. So it comes way down in that little tight pivot. So you get the real tight action, and then the 1-2 punch, the big volume comes in. Again, it's not a coincidence. I said that a lot of times. I'm going to say it again. This is not a coincidence. You see it happening over and over and over. But to get to that point, it's got to culminate. It doesn't mean that every time there's low volume that there's going to be a breakout afterwards. It has to culminate to all these things coming together. That's what specific entry point analysis is. My strategy is about having all these elements coming together to one specific point, one day, where that's where you should be placing your buy based on a whole bunch of probability. I call it probability stacking, where you're putting all these elements together where the probabilities are very high for a successful trade. Now, here's the weekly. Remember, I said the weekly, you're going to see it on the weekly too. See, perfect. Looks beautiful on the
See those
weekly.
blue bars, all those are all big institutional accumulation bars.
That's just a classic cup with handle. That's all that is, just a big cup with handle. That's an O'Neill cup with handle. Now, Body Central, I was in the mall. It was around Christmas time, right over here in December. And I was with my wife, and there was a Body Central in there. And I walked in and I said, wow, this place looks interesting. It's real. The stuff was real youthful, and it was all colors. And I thought it was, a great looking store. But whenever it comes to fashion, I asked my wife, and she liked it. And she said, yeah, it's a pretty cool store. This looks like, kids would like this. So I just looked up to see if it was a public company, and sure enough, it was starting to set up in a primary base. So it was right at this point, right here. You can see December, around right before December 25th is right here. Just a few days later, it was setting up in this pivot, and so I bought it coming out right here. I sold right into this rally here, so I was gone in like 4 days, but I made a nice quick little rip on it. This never went on to be a really big stock over over the long term, but a nice move in 15 months, up a double. Michaels, I bought Michaels here. I think if I remember, I think David Ryan and I were buying it on the same day right here. Came out real nicely a couple of days later. Wasn't very long, but 4 months to get 60%. Pegasystems, I bought this back in the mid 90s. I bought some here. I actually sold it into this first rally, and then I bought it back here. It got even way better. I mean, look at the tight price here. I mean, you can't get much tighter. So again, almost no variation in these few days. And then both were very explosive coming out of there. Phillips is one that because I tend to shy away from the cyclicals a lot of the times. I did not buy this one, but I watched it painfully as it set up, really perfectly. It broke out. I didn't buy it. I don't know if you saw this one too and passed on it, but
I did the exact same thing.
but it took off, and in 6 months later, it was up 130%. This is Phillips on the weekly, and just looking from that point, from here where it's set up is right over here. Nice move here, really nice move. It held a 10-week the whole time, and then it went into, this is a perfect example of going back to the beginning, the stage analysis. So we got stage 1, it gets into stage 2, breaks out, all the gain is made in stage 2. Now you get this big, see this right here? That's not a VCP. It's too deep. It goes from $80 all the way down to a little over $45. That's almost a 50% decline. It's just a lot of volatility. And even though it tightens up on the right side here, this is what O'Neill calls wide and loose, just way too much volatility. And now you roll over here, and just volatility all over the place, and you're now in the stage 4. So you go stage 1, 2, 3, 4, absolutely perfect. This is a faulty VCP. So here's Shopify. I was in Shopify a few times, but I did not buy it here. But this was set up perfect. This is actually one that I did not see at the time. It was later on when I saw that I missed Shopify. I said, was there anywhere that I should have got on this thing? And then I looked back on it, I went, wow, how did I miss that? It was so obvious. If you take a look at the weekly looked beautiful. Here's another tip about these IPOs. When you get an IPO, and if you go back and you read How to Trade in Stocks by Jesse Livermore, it's a little book, it's like 100 pages, one of my favorite books on the stock market. He talks about how to buy IPOs, and he says once an IPO goes IPO and it corrects, that it's a relatively safe bet to buy it when it makes a new all-time high after the IPO. What I have found, I found that, which was in the 1920s and 30s, to be true to this day. But what I would add to that is that you want to have that occur coming from a volatility contraction pattern. And that's exactly what happened here. You come up this right side, you get into new high ground, and then it forms this first base. And so if you see a recent IPO, maybe it's an IPO a year, within the last year or two, and now it's setting up and it's going right into new high ground, all-time highs or close to it. Maybe it's already in new high ground, it's up 30, 20, 30, 40% to new high ground, that could be a really big winner. That's just setting up in the very early stages. I always entertain those and
yeah. And Mark, just
try
to
to
add
buy
that,
those.
I made that point earlier. Sometimes these take time. This is a really good example, and I remember this one well because this was early 2017, if memory serves me correct, and there was a couple. This one, Alibaba, Square, ANET. There were a number of these stocks that had gone public, I think in 15 or 16, which was a little bit of a choppier, tougher market, similar to Ollie's. Ollie's was earlier, it broke out, I think, in 16, like you showed. But this was a theme, and there were a number of these that they'd been public for a couple of years, but then they started to tighten up on that right side. And I think Square was a monster. This one was a monster. So yeah, they're really powerful.
Yeah, here's another one. Just I'm not sure. Let me just see something here. Just want to say I'm not sure how this got into the IPO. Maybe it was an IPO previously, but not sure how that got in here. Burlington. This is another one. This is another David Ryan. David Ryan actually brought this stock to me. It was setting up, and again, he was talking about how, so I don't know, something about it was a really cold winter, and people were going to buy more coats, and he had this fundamental thesis. And to me, I said, okay, man, it's coming out of a nice pattern. I'm going to buy it here. Sounds good to me. So we bought it here coming out, and it worked out. Over the next 4 years, it made a nice move. But you can see here, you see how, again, you look to the left for traffic. You look for that supply. It bumped against this area, and see it came off each time, came off hard here, but each time it's coming off less and less and less. And you can see the line. This is what Livermore called the line of least resistance, where you get that supply line, but then it tightens up into that supply and it quiets down. That tells you that that supply has diminished, has stopped coming to market. And now your chances for explosive price action are the highest out of any time in this price action here. The chances for explosive price action and for a big move are right there, not over here, not here, because it didn't tighten up yet. It didn't give you that indication. Now it's giving you that indication, and it's gone through time. These iterations, these tightenings, these volatility contractions are telling you that there's less supply. Each time the supply is diminishing and diminishing and diminishing until finally it quiets down to where you have that low risk entry point. Again, there's a very good fundamental reason behind what I do and how I do it, and this is just this is building on work from Livermore, from Richard Love in the 60s and 70s, from O'Neill in the 80s and 90s. And then, I'm sort of like the next generation and taking this to another level. And I'm sure there's guys out there that are, learn from me, and certainly Mark Ritchie's one of them, and other people that have read my books, that they'll take it to another level, and there'll be observations that maybe I'm missing, or there'll be some kind of new tactics. The thing is that, we've tried to look for everything, because we look at history and my own 40 years of anecdotal evidence. And what I find is that I'm not doing really anything different than Jesse Livermore was doing, or Love, or O'Neill, or Nicholas Darvis. We're all doing the same thing pretty much. It's really a timeless approach. It just takes a lot of time to get the skill to put this all together. You talked about LinkedIn, Mark. Here it is. LinkedIn. I bought LinkedIn right here. I watched it IPO. I didn't touch it. It had a huge decline, just like Facebook. Came all the way back. Again, look how it forms the line of least resistance. See, it comes back here, and each time less supply, until finally it really tightens up. And this meets a couple criteria. First of all, it goes through and you got the nice volatility contraction, right? Well, and also it meets the Livermore rule. It's making an all-time high here for the first time since here's its IPO. It came back right up to that level, but could never make a new all-time high. As soon as it makes that all-time high and comes to that out of that VCP, it just rips off. It comes right out here. I was actually on CNBC, and I right after this weekly bar here, I gave this stock on CNBC. It was funny story. Maria Bartiromo. I went on with Tyler Mathis and Maria Bartiromo, and prior to going on the show, they had said to the person who booked me, said, we want Mark just to give us his one pick, which I hate when they ask for that. Just give me his favorite stock. What's the one stock that he would load the boat on? So I was like, all right, I'll do it. And so I go on there, and they're like, hey, Mark, you're the market wizard. What is that one stock that you would pick right now that you would tell everybody to buy? And I said, well, that one stock is LinkedIn. I said, it just took off and broke out, and it's up real big on earnings. This came out on earnings. I said, and that's not your Aunt Betty buying there. Those are institutions piling in. So the future looks good for this stock. And Maria Bartiromo completely blindsides me, and she goes, oh, come on, Mark, you're not telling people to put everything into one stock. That's ridiculous. I was like, damn, they set me up and sent me to the wolves there. But anyway, it ended up working out. Anyway, at this point right now, we're going to take a quick break, and then we're going to come back and we're going to talk about the velocity play, the velocity opportunity. We talked about the magnitude opportunity, which is the recent IPOs, and how you're getting in at the earliest point that you could, subsequent to the IPO. Now we're going to talk about something that is close to Mark Ritchie's heart. He's done a lot of work and come up with actually some improvements upon some observations to be able to improve the way you play what we call the power play, which is built on the height tight flag, the O'Neill height tight flag, which goes all the way back to Giller and Love, and even to a certain degree Livermore. And we'll talk about that when we come back. So we're going to take a break, and we'll be back here in just shortly. Okay.
Okay, guys, that was the failure reset, pivot and base failure reset, as well as the primary base magnitude play. We're going to take about a 5-minute break here, get up, do some jumping jacks, get the blood pumping. We're going to be coming back with one of my favorite sections, which is the power play. And we'll do that after a 5-minute break. Stand by.